Morning, everyone. It's 10 o'clock now, so we're going to get started. Thank you to everyone who has joined our webinar this morning. We are going to be recording this, so there will be a copy available for everyone afterwards. As a way of introduction, my name is Abbie and I'm one of the partners here at PJCO.
Hello, my name is Sophie and I am tax partner here at PJCO.
To give you an idea of what we're going to cover in this webinar, we're going to run through some tax planning opportunities that you may wish to utilise before the current tax year finishes on 5th of April 24, including some points for those of you that run your own business should be thinking about. We're going to look at the positive impact making pension contributions can have on your personal tax position, particularly if your income is at the 50k or 100k threshold. Then we're going to run through some of the changes to the basis period reform that will affect some sole traders and partners in partnerships, as well as some of the other changes that were announced in last week's spring budget, including a reduction in the higher rate of capital gains tax. There will be a chance for questions at the end, so please save them for us until the end. Before we do get started, we just wanted to have a quick refresher on the income tax bandings. It is worthwhile noting that the dividend allowance is decreasing again from the start of the new tax year. So it's currently set at £1,000, but it will be reducing to £500. So if you do run your own business and you're not sure if you have utilised your tax-free dividend allowance, please do get in touch with your client manager here and they can help you to assess your position. If you do find yourself that you have available profits in your company to vote this dividend, it is very much worthwhile utilising this tax-free allowance. Something we also just wanted you to be aware of is something that's called adjusted net income. So this is calculated by working out your total income and then deducting any pension contributions or gift aid donations. And Sophie's going to cover this in more detail next.
Thank you, Abbie. So let's look at the first tax trap. So this is income between £50,000 and £60,000. So once you exceed 50,270, you will begin to pay 40% income tax on any income over this amount. If you or your partner have net adjusted income over 60,000, which as Abbie mentioned, is your total income less any pension contributions or gift aid donations, you will need to repay your entire child benefit. If your income is between 50k and 60k, for every £100 you exceed 50k, you will need to repay 1% of the child benefit. This applies to the higher earner out of you or your partner, and they will need to declare this on a self-assessment tax return. So if you don't complete one already, you will need to complete one. A few tips: even if one of you has income over 60k, if the other partner has little or no income, it is still worth claiming the child benefit, as a receipt of this counts as a credit towards your state pension. You could even pop this into a savings account and earn some interest until it becomes due. If your income fluctuates, again, I recommend claiming the benefit and keeping it aside just in case you need to repay it, as you cannot claim the benefit retrospectively. As mentioned, the threshold is based on your net adjusted income, and therefore you may wish to consider making a pension contribution to bring this down. So this is an example of making pension contributions to reduce your adjusted income. On the left, we have a salary of £60,000 and no pension contributions, which means that you would lose all of your child benefit, and income over 50,270 will be taxed at 40%. On the right, we can see the effect of an £8,000 contribution. Just a small disclaimer, I have rounded these figures, as £270 will not get the additional 20% tax relief. When you pay into a pension scheme, you will pay the net amount, so that's 80%. The government will then top this up to 100% by adding the extra 20% to your pension scheme. Therefore, if in your pension scheme, if you contribute £8,000, the government will add £2,000 and you'll have £10,000 in your pension scheme. If you are a high rate taxpayer, which you will be between these two thresholds, you will then receive the additional 20% relief by extending your basic rate band. This gives a tax saving of £2,000. Therefore, £10,000 in your pension pot would only cost you £6,000. If you then factor in the child benefit, you do not have to repay. For a couple with 2 children, £10,000 in your pension pot would only cost you £3,000. When you're earning 60,000, 8,000 seems like a lot of money to put in your pension scheme. When you factor in these savings, £3,000 seems a lot more doable. So the high income benefit charge is really unfair for single parents and single or dominant earner families. So for example, a single parent earning £60,000 will not get it. However, next door, parents both earning £49,000 will get the full amount. Therefore, HMRC have reacted to feedback and have announced in the budget last week that they will reform this. So from 2026, this will be based on household income. So both of your incomes added together. However, they also commented on the difficulty of making this change. So watch this space. From April 2024, however, they have increased the threshold at which you begin to lose your benefit from 50,000 to 60,000. And the upper threshold is 60,000 to 80,000. So that rather than losing 1% for each £100 over the threshold, you will lose 1% for each £200 over the threshold. The next tax trap is known as the 60% tax trap. So once you earn more than £100,000, you begin to lose your personal allowance. This goes down by £1 for every £2 of your adjusted net income above £100,000. So when you go over 125,140, you completely lose your allowance. This means that someone earning between £100,000 and 125,140 faces an effective 60% tax rate on that portion of their income. So let's imagine you earn £110,000 or £10,000 above the threshold. You would pay 40% tax on the £10,000, and you'd also lose £5,000 of your personal allowance, costing you another £2,000. So a total tax of £6,000. In addition, once you exceed £100,000, you also lose your tax-free childcare. So tax-free childcare is effectively a savings account for childcare costs. So for every £8 you put into the account, the government will pay £2 up to £2,000 a year. You also lose free childcare for working parents, which is currently 15 hours for 2-year-olds and 30 hours for 3 to 4-year-olds. For nurseries in Brighton and Hove, the average cost of childcare is £3.68 an hour. Therefore, 15 hours a week works out about 2,870 and 30 hours, 5,741. Again, the threshold is based on your net adjusted income. So let's have a look at the effect of pension contributions. So on the left, we have a salary of £110,000 and no pension contributions, which means you would lose £5,000 of your personal allowance, tax-free childcare and free childcare. On the right, we can see the effect of an £8,000 contribution. As in our previous pension example, you will receive a top-up of 20% in your pension, resulting in a total amount in your pension of £10,000. You would also receive tax relief of £4,000, which is £5,000 back of your personal allowance at 20% and £10,000 tax relief at 20%. Therefore, £10,000 in your pension scheme would only cost you £4,000 before you consider the tax-free childcare and free childcare savings. If you had a child aged 3 to 4 years old, you would actually save money by contributing £10,000 into your pension. Because the cost is £4,000, yet you'll claw back the £5,740 of free childcare. So you'd actually save £1,740. As a side note, you may also want to consider asking your employer to deduct pension contributions via salary sacrifice, as you'll also save national insurance. However, this will also reduce your taxable income for mortgage purposes. So this is a consideration.
Now we're going to move on to gift aid donations, and there is tax relief available to you when you donate to charity. So what donating through gift aid means is that you can claim an extra 25p for every £1 you give. So in our example here, for every £1,000 you donate to charity, this makes your donation worth £1,250. If you are paying tax above 20%, so you're paying tax at higher or additional rates of tax, you can claim back the difference between the tax you paid and what the charity receives. So if we look at our example, if you did donate £1,000 to charity, they claim gift aid to make your donation £1,250. And if you are a high rate taxpayer paying tax at 40%, then you can personally claim back £250. And this is calculated as 20% of the gross donation of £1,250. So therefore, if you are a high rate taxpayer, a donation of £1,000 will only actually cost you £750. And over the next couple of slides, these are really directed at those of you who run your own business. So you run the company and you draw a salary, but you also own the company and have a right to dividends. This month, before we come to the end of the tax year, it is really worthwhile assessing how much dividend income you've received from your company and where your income falls within your income tax bandings. If you are in a position where your total income is less than your basic rate threshold, then you might wish to draw some additional dividends from your company. What this will mean is that it will then utilise the remainder of your basic rate band that you have left, and you will benefit from only paying basic rates of dividend tax on this income. If you are in a position where you are looking to get a mortgage, or perhaps you've got a remortgage coming up, it may also benefit you for this purpose to declare a higher income. Or another example, perhaps you have a higher standard of living. So say, for example, you regularly draw 80k each tax year, and say there's 1 year that you've got a particularly big purchase, or you wanted to do some house renovations, for example. So you would have been better off drawing up to 100k mark over a few years, rather than having to draw an extra 100k, say, coming out all in one tax year. As what you would find is that you'd be paying 60% tax on 25k of that income, as you would lose all your personal allowance, and you'd also be subject to additional rates on a proportion. Just to note, your company does need to have the available retained earnings to be able to sustain the extra dividends. So if you do need help assessing your company position, then please do get in touch with us. So alongside dividend income, we should also be thinking about pensions and your personal pension position, and how you might be able to utilise spare cash in your limited company and put this into your personal pension pot, as it is the most tax efficient option. So the way it works with your company is that your company would make an employer pension contribution into your personal pension pot. And then this cost is recorded as an expense in your company books, and in turn reduces the amount of profit the company is subject to tax on. Using an example, if you are paying corporation tax at 25% and you were to make a 10k pension contribution, this would save you £2,500 in corporation tax by doing so. What you want to make sure is that you have made the contribution before you get to the end of your company's financial year, as you cannot backdate these contributions. As well as that, as we no longer now have one rate of corporation tax, and once your profits go over 50k, you are subject to a higher rate of corporation tax than 19%, up to a maximum of 25%. If your company has made profits over 50k, what you could do is make a pension contribution to reduce your company's profits to 50k, and then benefit from still being taxed at 19% corporation tax. In regards to pension allowance, the standard pension allowance is now 60k. So you could make a contribution up to this threshold each year from your limited company and start to build up a pot for retirement. As well as that, depending on your circumstances, you might find that you have unused allowances from the previous 3 tax years, which means that you could be in a position to be able to put in up to 180k into your pension pot, which would save you a maximum of 45k in corporation tax.
So another way of reducing your tax liability, maybe once you've maxed out your thresholds, is to make investments in EIS, SEIS, and or VCTs. So these schemes are designed to encourage individuals to make investments in higher risk, small to medium size unquoted companies. So these are not the big companies that you'd usually see on the stock exchange. So EIS companies are companies that made their first commercial sale less than 7 years ago. They have less than £15 million in gross assets, and they have less than 250 employees. So they're still reasonably sized businesses. And then SEIS companies are much smaller companies that are less than 2 years old, have less than £200,000 in gross assets, or less than 350 for shares issued after the 5th of April 2023, and have less than 25 employees. So by investing in these schemes, you can claim 30% tax relief on EIS or 50% tax relief on SEIS. So for an investment of £1,000 in EIS shares, you will pay £300 less tax. So relief is available in the tax year shares are issued or in the previous tax year. So you could invest in some shares in 24-25 and then roll back to this current year. You need to hold the shares for 3 years, otherwise there is a clawback of this relief. You also get loss relief. So if the shares are disposed of at a loss, you can elect for the loss to be set against the income of that year or the previous year again. And this reduces your taxable income. There's also CGT's disposal relief. So any gain is free from capital gains tax if this investment is held for 3 years. CGT reinvestment relief. So if you sell a capital asset, such as a property or any other shares, you can defer this gain by investing the proceeds into these shares, so EIS or SEIS. And they're inheritance tax-free. So provided that you've owned them for at least 2 years and it's in a qualifying unquoted trading company, you can get business property relief at 100% and pay no inheritance tax. So let's look at a few examples of how these work. To make the maths easy, I've assumed you've invested £10,000 in each case and you're in 45% tax bracket. So in the first scenario, the company does really well and doubles its value. You receive tax relief of £3,000 and you do not pay any capital gains on this gain. Therefore, your total gain is £13,000. In the second scenario, the value stays the same. You receive income tax relief of £3,000. You pay no capital gains tax because obviously the value stayed the same. And therefore, you make a gain of £3,000. The third scenario is worst case. So the company closes and your shares are worth absolutely nothing. Your investment was £10,000 and you've received tax relief of £3,000. Therefore, the capital loss is £7,000. You'll then receive tax relief on this capital loss at your marginal rate of tax. In this case, we've used 45%, and therefore your actual loss is £3,850, which is a lot better than the £10,000. You can also invest in venture capital trusts. So this is a listed company that takes minority stakes in many early stage companies rather than standalone. So the risk is spread. Similar to EIS, you will receive 30% income tax relief on VCTs, but these must be held for 5 years rather than the 3 years. One key difference between EIS and VCTs is the tax treatment on dividends. So dividends paid out to VCT shareholders are tax-free, whereas dividends paid out to EIS shareholders are taxable. It is worth noting that dividends are much more commonly paid out by VCTs than they are EIS or SEIS. This is a nice tax relief when dividends from other companies could be taxed at 33.75% or 39.35%. You could also invest your dividends received from regular companies into VCTs, meaning that these would only get taxed at 3.75% higher rate or 9.35% additional rate. And then again, any gain is capital tax free if you hold the investment for at least 5 years. So investing in startups and early stage businesses is incredibly risky. So if you would like investment or pension advice, we can put you in touch with our in-house financial advisors.
The next couple of slides are really going to be for those of you that are self-employed traders or partners in partnerships and have an accounting year end that is different to 31st of March or 5th of April. So HMRC have announced some new rules that bring your accounting year in line with the tax year, known as the basis period reform rules. This current tax year will be the year you will need to transition to the new rules, and it will likely result in additional tax due on additional profits. This is probably best explained if we use an example on the next slide. So if you are a self-employed individual and you usually prepare your accounts to October each year, when you will have come to complete your October 23 tax return, you will have declared profits to October 22 on that tax return. And based on the current rules, the next set of accounts you would have prepared would have been to October 23, and you would have included that period on your next tax return to April 24. However, now what the changes do mean is that your April 24 tax return will still include the year to October 23, as you would have originally prepared, but it will now also need to include the period from 1st of November, should say November rather than October, November to either 31st of March 24 or 5th of April 24. So using this example, that actually means you're going to end up with a 17th month period of profit and loss to declare. Now, what HMRC have said is that to try to alleviate the tax impact of these additional profits that need to be declared, taxpayers who are affected will be able to deduct any overlap relief from their transitional part profits and spread any remaining transition profits over the next 5 years. So really, as a result, if these changes affect you and you do find that you've got significant expenditure that you need to pay out for, it was really worthwhile doing it before the end of the month to be able to reduce the profit you need to declare. Another suggestion would be that you actually think about changing your year end to either 31st of March or to 5th of April, as it will be much simpler and it will be much less work for you each year when you come to complete your self-assessment.
So moving on to capital gains tax. So from the 6th of April 2024, the annual exemption, which is your tax-free allowance for capital gains, is decreasing further from £6,000 to £3,000. This will result in the additional tax shown on your screen for residential property and other capital gains. Therefore, if you're thinking of selling any cryptocurrency, shares, or any other assets at a gain, it may be worth doing so before the tax year ends. However, there is an exception. If you are a higher rate taxpayer thinking of selling a residential property, and this is due to a budget change. Last week, it was announced that the higher rate will be reduced from 28% to 24% from 6th of April 2024. So if your gain is likely to be more than £24,000, it is more worthwhile to push back the sale to 24.25. The gain is calculated on the exchange date rather than the completion date. However, if you do sell a residential property, you will need to report and pay the tax on this within 60 days of the completion date. So they're different dates. So please get in touch if you need help with this.
Another change that was also announced in the budget last week was that the Furnished Holiday let regime will be abolished. So this will eliminate some of the tax advantages that if you are a landlord who has let out short-term furnished holiday properties, will be affected by, and this is going to take effect from April 25. So at the moment, the benefits to the scheme really are that you're able to deduct the full cost of your mortgage interest payments against your rental income. You're entitled to capital allowances on furniture, and you can also benefit from paying lower capital gains tax on sale and being entitled to CGT rollover relief. But now, unfortunately, these will no longer apply from April 25. Some of the other changes in the budget that was announced last week, the VAT registration threshold has increased from 85k to 90k. They announced that stamp duty land tax relief for those individuals purchasing multiple properties at the same time, known as multiple dwellings relief, has been abolished. National insurance for employees is going to be reducing to 8% from the start of the next tax year, along with national insurance for self-employed individuals, which will also be reducing to 6% from the start of next tax year. There's also been a new scheme announced for those individuals that are UK resident but non-UK domiciled, and that probably needs its own webinar dedicating to it. So perhaps we will cover that next time. That brings us to the end of everything that we wanted to cover, but we wanted to leave enough time for everyone to ask us questions. So if you do have any, please feel free to pop them over to us now. Thank you.
Any questions? Thank you, Chris.
We will, like I said, we will share the webinar recording as well, so you've got a copy of it. There's been a lot of information in this, but we were trying to capture as much as possible. So hopefully everyone found it useful.
And also, if you do think of any questions after the webinar, after you've watched the recording, then you can always send an email to your CPM or just give them a call. What happens if I've claimed, what was that question? What happens if I've claimed capital allowances on furnished holiday lets in the past? HMRC haven't clarified this yet. So we're just waiting the guidance. And as soon as we have that, we'll share it with you guys.
yeah, we're really waiting to see how we transition from the current rules to what the new rules are going to be, and how that works for people that have a furnished holiday let at the moment.
And if you were looking to sell the furnished holiday let, obviously business asset disposal relief will be available up until the end of 24-25. So that's 10% capital gains tax on it rather than potentially 28%. That's a good question from Ella. Is it more beneficial to put pension contributions from your company into your SIPP to get the corp tax relief, or to put personal pension contributions as a director?
I would say that if you've got the ability where it's your own business, so you are the director and the shareholder, then I would be putting the contributions in from your limited company. So making sure it's really important that you make sure that the pension provider knows that you want to make an employer pension contribution into your personal pension pot, rather than making a personal pension contribution. So then the pension provider knows that it's coming from the company, and it knows that you're going to claim the tax relief through the reduction in your corporation tax relief, rather than top up the 20% if you were making a personal pension contribution.
Another question, how long does it have to be a furnished holiday let to get the 10% capital gains tax? And that's 2 years. So it has to be owned for 2 years before you sell it to get the 10% relief. And you can't have maximised your £1 million limit prior to that. Cool, I think that rounds out the questions.
I will just go back to slide number 1 and leave our email addresses on the screen. If you do think of any questions, please feel free to pop it over to Sophie or I, and we'd be more than happy to see if we can help you, particularly if you've got an individual question that perhaps is particular to your circumstances and you might not necessarily want to put in the chat on this. But yes, pop it across to us and we'll see if we can help.
Cool. Thank you for attending.